We've been hearing about the problems of the Silicon Valley Bank for weeks. Why are people still talking about it? Actually, it looks very serious. I am going to share to you what Greg Jensen, the Chief Investment Officer of Bridgewater, the world's biggest hedge fund, is saying in a discussion with his team. If you are interested, the link to the full half-hour-long discussion is in the link below. As you may know, Bridgewater belongs to Ray Dalio. So a lot of insights and thoughts often reflects what Ray is thinking. Then I will break it down to make it easy to understand what is happening. So to start off, let's see what they are saying.
So the first wire was exactly that. It was diagnosing the bank run itself. Where was money leaving? Where was it going? The second part was looking at how this earthquake in the banking system will affect credit pipes going forward. And basically, there's three big things that we take away from that. One is the effect on bank profitability. That's going to be rippling through the system as it gets more expensive to hold on to deposits. The NIMs across the sector are going to be hit, and that's going to ripple through in terms of creating some zombie banks that really have negative profitability at this level, and a bunch that are a lot less profitable than they were. The second part of that is probably no matter what happens from here, the lesson of banks and the amount of duration it's safe for them to hold is rippling through. In some cases, literally banks are being closed and that duration has to be sold into the market. You're likely to see very little purchase of duration by most banks and the rolling off of duration in many banks, which means you have to find somebody in the private sector, somebody else to make up for the fact central banks aren't buying duration anymore and the banks aren't buying duration and they're the only buyers of duration at current interest rates. So that's a big deal. And then third, the shift from small to big. The fact that small banks, of course, have been hit the hardest by the events. Big banks are getting bigger. That's going to have a flow through the macroeconomy because there are elements of the economy where small banks are critical. CRE comes to mind and other places where lending to small companies and those things are going to be the most affected by this crisis. And then in the third wire, it was really, well, how will all of that net out for the economy? The basic picture is that rates drop, the Fed gets into buying assets. That made the ability for banks to be profitable in their old business much lower than it was. And the fact that post financial crisis, there was such a credit hangover that the private sector wasn't created that much credit, that as banks didn't have that much to do with the deposits that they got, and they got more deposits due to QE, that they started on taking on more government bond, government guaranteed mortgage issuance as the assets that they were holding. And then that trend massively accelerated in the pandemic when you had a huge surge in deposits based on MP3 policies that pushed money into the banks at record rates. And again, there wasn't enough private sector credit to keep up with that.
Greg compared this to an earthquake. Why? He mentioned the impacts on both the depositors and the banks itself. Let's start with the depositors, which is us. The crisis has made us aware that our checking account, which is earning 0.01%, is a bad choice. It is not safe. Whereas, the T-bills, from the money market fund, is earning 4.75% and is much safer. It is not just getting a few more interest, but it means not losing the money. Once more and more people understand this, much more deposits are going to leave the banks and goes into T-bill investment. Over the 2 weeks in March, more than $500 billion has moved this way, behaving similar to a bank run. Earthquake number 2: the banks itself. They are holding long-duration assets coming out of COVID. Previously, there were little demand for credit in the private sector. Banks then invest in long-duration assets like the long-term government bonds. A long-duration asset simply means that the bank must hold the asset for a long time to have a profit. If they sell too early, they will make a loss. Banks have been used to deposit sources which are stable, so they are confident to take risk. This has been happening since the end of the 2008 crisis. Now they have seen that they can vanish in a matter of days. They will then need to adjust their investments. They will have to start to sell long-duration assets that they were holding at a loss. But the bottom line is, there isn't enough demand for these assets. In the past, the Fed and the banks themselves were buying these assets, else the foreign central banks will be buying them. But at the same time, governments will want to sell more of them as they are always in a budget deficit. Then, the question is, who will be buying them? The people at Bridgewater thinks that the natural demand from pension funds and insurance funds will cover only half of these. So if you ask what could happen next, In the discussion, Greg talked about two things. First, the bank's profitability. With a double hit, by potentially having to sell long-duration asset at a loss, and the need to offer higher deposit rates to keep the deposits from leaving. Banks' profits will drop significantly. Some of these zombie banks that has not been well managed could face losses for many years or even being shut down. The Bridgewater team estimate that if the cost of funding, or the cost of deposits, goes up by 1% across the industry, then about 2/3 of the return on equity will disappear. The second point is the liquidity drying up. Smaller banks are the one hit the hardest. They are also the one who provide the actual loans to the real business, whereas the bigger banks do more of a financial engineering. The smaller banks will have no choice but to raise their lending rates to fix their own problems. As the smaller banks gets into trouble, the knock-on effect will be less source of money available for real projects for businesses to invest. While people believe, when there are signs of the recession, the Fed will ease the interest rate very quickly, like they did over the last 30 to 40 years. Which will help us through with only a shallow recession. However, due to the ongoing inflation dynamics, and the mandate of the Fed to move the inflation back to 2%, it is more likely that the Fed will hesitate. The cracks in the economy will open up more and more. On top of the liquidity drying up, there is yet a cycle of a credit default problem. A potential scenario is that, as the Fed fund rates is still high, the next refinancing of business debts will be at a much higher rate. This could trigger the credit default cycle, which makes everything worse. The last thing to point out, which is probably the most worrying, the Bridgewater team did not discuss this in details, but if you have been following the works of Dalio and his team, there is a message between the line, and this is a big deal. Earlier, when we said that there is not enough demand to purchase the long-duration asset, like the long-term government bonds. But, at the same time the US government will want to sell more of these. As someone has to buy these assets, or another word, lend money to the US government. There could be two possible ways things can end up. One, the Fed will have to increase the yield or the interest rate high enough, so that the world has an incentive to buy these assets. Given that the recession is around the corner, as well as the coming presidential election, this will not happen. 2. The Fed will lower the interest rate. But this time, it must buy the government bonds. This is sort of another QE. In effect, this will be printing more money into the economy. This is very dangerous and could lead to a heavy devaluation of the dollar. And the risk of losing the dominance as the world's reserve currency. So the next 2 years could be very tough for the US and the world economy. Thanks for watching. Follow us if you like the content.